I read the news so that you don't have to. Chelsea Football Club, they are losing money so fast, it's making the Roman Abramovich era look financially responsible. And that should scare you. So this headline says how Chelsea's private equity revolution ran into trouble. Let me explain, but first to explain, I need to rewind. So under Roman Abramovich, Chelsea basically ran like a billionaire's hobby. We're talking losses of around £1 million a week for nearly 20 years. But here's the thing, they were winning Premier League titles, Champion Leagues, trophies on trophies. Fast forward to today, Chelsea is now owned by Clearlake Capital and Todd Boehly. And this was supposed to be different, more structure, more discipline, less chaos. Instead, they've just posted a £262 million loss in 1 year. FYI, that is the biggest loss in Premier League history. So let me give you the breakdown, because here's where it gets interesting. Chelsea isn't being run like a football club anymore. It's being run like a private equity experiment. They've spent around £1.5 billion on players in just a few years, but instead of buying finished stars, they've been buying young talent. Why? Because in their minds, players aren't just players, they're assets. So you buy low, develop, and sell high, like stocks. There's a problem. Football is not an Excel spreadsheet. When you treat your squad like a portfolio, you might end up with a team full of potential, but no actual leaders. And this is where it starts to unravel, because the entire Chelsea strategy depends on one thing: winning. Chelsea makes serious money when they qualify for the UEFA Champions League. We're talking 75 to 80 million euros a season, but right now they're sitting 7th in the league, which means no Champions League, no big money. And then there's the real issue: the stadium. Chelsea's ground, Stamford Bridge, holds around 40,000 people. Compare that to Manchester United, their stadium holds 74,000 people and generates nearly double matchday revenue. Whereas Chelsea, they haven't even decided whether to rebuild or to move. And in private equity terms, that's like not knowing where your biggest future cash flow is going to come from. Now let's talk about debt. Chelsea has a $500 million loan with an interest rate of over 11%. But here's the twist: because it's a payment in kind loan, which means they're not paying the interest now, it's just stacking up. It's like putting everything on a credit card and hoping that future you somehow figures it out. Now on the pitch, they've gone through multiple managers in just a few years. Players are questioning decisions, fans don't trust strategy, and even people inside football are saying this is risky. So here's the big question: what happens when you try to run a football club like a hedge fund? You get huge spending, huge losses, and the team might be worth more in the future, but isn't winning now. And here's the irony, because under Abramovich, Chelsea lost money, but bought success. Under private equity, they're losing even more money and still trying to figure out how to win. And that is a very expensive experiment.